So, Tracy, the last time we chatted, 2025 was looming in the headlights. We're now nearing the end of the first month of the year. There's a new president in the White House. The prime minister has stepped down, and now we're heading to the polls in the next 6 weeks, rather, here in the provincial election. Lots to sift through, and I would think that the real estate market might be adjusting on the fly in some ways. Are things a little bit hectic right now when it comes to the real estate market?
Yeah, I mean, it's definitely been an interesting 3 weeks of the start of the year. We've had a lot go on, obviously, with what you said. You summed it up really well. And I think, people are more educated and really on the pulse of what's going on politically, economically, and financially because it's affecting their pocketbooks. So I think right now a lot of people are very cautious on making decisions when looking at home ownership and if their mortgage is coming up for renewal, what is the impact of some of these political ramifications going to do on their financing in the future? And it's hard, like no one can forecast, but I think that we have to just educate people as much as we can and help navigate these waters because every day, it's not every week, but every day is a different conversation of what is being said or what's being transpired. And you're right, we have a shift in probably political parties this year federally. We've got a provincial election coming up that might be a shoo-in, but you never know. Politics is always different, right? So I think that it's heavy on everyone, and to be able to break it down and help people navigate will give people clarity. I mean, one thing we can say, I've been in this business 26 years. I say it's all my life because my parents were bankers. And no matter what economy and inflation or disinflation market we're in, we do 100% recover. It just will look like a different lens and things do settle down. So I think people are exhausted because we've consistently had change. But I do think that this year will be stronger for us economically. I think it will be stronger from a housing perspective once, the first quarter of this year settles down with some of these initiatives.
There's a sentiment out there that some people are like, I don't want to pay attention to any more of the news. It's all negative. It's this. This is probably the most important time to be paying attention to what's going on.
Absolutely.
I know that for us, our mortgage is just coming up a year out from now, so we're already starting to take a look at what are the what ifs and where we're going to be, and we can retire in a couple of years. How that's going to play into everything. You can't bury your head in the sand. You need to be able to pay attention to what's going on. Bruno, from your point of view, all of these changes in sort of the outside world, I guess, in some ways, how does that impact on what you do on a daily basis as well?
So on the mortgage side, of course, that's what we're looking at. And when we look at interest rates and you look at fixed and variable, fixed rates are priced off of the 5-year Canada bond yield, which is heavily influenced by the 10-year Treasury yield out of the United States.
Right.
And with all these talks of tariffs, when I look at the ramifications of tariffs, of course tariffs will hurt Canada. If there's a 25% tariff levied on Canada, it's going to hurt Canada economically. But inflation in the United States is not subdued. Inflation in the United States was 2.4 in September. It's now 2.9. In Canada, we're at 1.8.
Right.
And if you launch tariffs, you're launching a tax on your imported goods from Mexico and Canada and potentially China and so on. That is deemed inflationary, right? So what we have to be careful with in Canada, we hear a lot about, reciprocal tariffs. Well, we're already going to be punished economically by what's happening with the tariffs that the United States launches against us. Do we really want to hurt ourselves more by launching reciprocal tariffs against American goods that's just going to be inflationary? So we might get an issue here economically where we may need, potentially, and Scotiabank did a study on this, they may have to lower interest rates because of these tariffs. However, if we launch heavy-duty reciprocal tariffs, they might actually have to pause interest rate decreases or potentially even increase rates because those tariffs will be inflationary that we have. So if America punishes itself with tariffs, and then it's a lose-lose in my opinion, because Canada will suffer too, we just have to be very careful not to, because if we are in a situation where the Bank of Canada will look at this from an economic perspective and say, hey, listen, you know what, maybe we have to lower rates faster because of the economic implications, then we have to look at that. Now, January 29th, the Bank of Canada does meet. And that'll be an important day because, February 1st is lurking, and that's the date. We were told January 20th
That's
would be
right.
the date.
That's right.
And then there was a little pause. So what we do know, in my opinion, by these pauses, if this was such a great idea, he would have done it already.
Right. Yeah.
But because he didn't do it, now he's thinking about it. His Treasury Secretary is Scott Bessent.
Mm-hmm.
And Scott Bessent is a very level-headed, intelligent guy. And when he was going up in front of the Senate Finance Committee, I was watching the U.S. 10-year Treasuries. Every time he spoke, it
Right.
went down.
There you go.
Because he was calming people.
Right. Right.
Right? And he used to, believe it or not, work for George Soros.
Oh, okay.
He's a hedge fund guy.
There you go.
Now he's working for Donald Trump, go figure. So that's miles and miles apart. But anyway, we certainly hope that level heads prevail.
Right.
And we're able to work through this. But there is a lot of volatility in the mortgage market because of this.
That idea of, people want a pound of flesh, right? That it's okay, these tariffs are coming in from the United States, automatically let's retaliate. And instead, just hang on there for a little while. I mean, the Bank of Canada, its number one goal is to keep inflation at 2%. Mm-hmm. So they need to keep looking at all of these different options and saying, all right, we don't need to jump into making this the first step that we take.
I think we have to realize inflation is at 1.8%, and our unemployment is still high. We're at 6.8%, and actually, in Toronto, we're actually close to almost 9% in Toronto, which is the highest that we've seen probably in 18 years. So, provincially, yes, we have an election coming up, but, whoever is going to be our new premier, or if it's going to end up being existing Doug Ford, we have to look at this. I think last year was about housing supply and the crisis we have in the housing market in Canada. And that's still there. It's still significantly prevalent and not something that's going to be resolved overnight. You had to plant the seed, kind of like plant that tree, 10 years ago for it to go. And I think it's going to take some time to be able to rebuild. And I think this is why we've got a lot of mortgage rule policies that are coming into place to help people build generational homes and build up instead of, just building new homes in the ground because of costs. But I think that part of our problem this year is going to be about employment. Mm-hmm. And especially if these tariffs come in, no matter if it's 25% or if it's 10%, the issue is going to be, right, is that there's not enough jobs, right?
Yeah.
And it's how are people going to be able to afford cost of living, especially if we see that certain items are going to become very inflationary. And we're seeing, even right now, I was reading this morning about eggs right now. The cost of eggs has gone up dramatically because of what's happened with that flu, right?
Right.
And I think that we're seeing this. Food prices have not come down, right? Overall pricing, everyday living has not come down, and that's what's hurting people right now. And just to put this in the conversation about tariffs, it's hard for people to really have that rational thought of where is it going to be.
Right. Before we got on the air, Bruno, you mentioned the idea that you're going to be coming up and doing a presentation on tariffs, and I know you've got some other information you want to share with us, and feel free to delve in and let's have a little chat about that. We've got a few minutes before the break. So, what in the information that you're going to be sharing with people, what are the key takeaways that people need to know?
I think that some of the key takeaways would definitely be the volatility that these threats of tariffs have caused. Be careful not to guarantee an outcome, in my opinion, because we don't really know what the tariffs will end up being, how much will they, what will the impact be, will Canada respond? And when I mentioned that response, it's a Financial Post article for those interested. It's called Retaliation Against U.S. Tariffs Could Force Bank of Canada to Hike Rates, right? So that's the concern. I mean, I'm hearing a lot of rhetoric back that, we're just going to get back at them. I think that would be a bad approach.
Right.
Also, U.S. inflation is a concern. So U.S. inflation does drive the 10-year Treasury yield, which impacts our 5-year Government of Canada bond yield, which impacts our fixed mortgage rates. And right now, our fixed mortgage rates aren't that bad for prime, business. I mean, your mortgage broker could definitely talk more about that. But we got some pretty decent rates in the mid-4s where you can now, get a pretty decent payment and not worry about it.
Right.
And then, of course, there's variable. So in this article that I referenced, if we don't respond and we get a negative economic impact, the Bank of Canada would be forced to go the other way.
Right.
And if they do, well, then a variable would be something that you might want to consider, but it's very difficult to know and very difficult to guarantee an outcome because we don't know the impact. We hear the rhetoric, and I mean, basically, there's a lot of fear mongering going on out there. But I think Tracy made a good point. I mean, you look at the real estate market for what it is, and if you're a person who wants to buy a home and you want to buy to live in it, I always use my own personal example, and I say the story all the time. When we bought our first house, our son was very young, and we lived in a 1-bedroom apartment. Crammed in there in Toronto. I got an opportunity to get a job in Kitchener, and we bought a 3-bedroom semi close to a brand new school, across the street from a park. The payment was reasonable. You got to live somewhere. So the rates are pretty reasonable right now. They might be higher than they were 3 years ago, but they're still pretty good. So this volatility and not knowing, sometimes, you just got to look at your current situation and if you take a variable, are you going to toss and turn not knowing, is Canada going to retaliate, what's going to happen? Or if you take a fixed, you know what your payment is, you're not going to worry about it. So it all depends on a risk tolerance in having that fluctuating interest rate potentially.
What right now are buyers and sellers, what are they expecting here in the region? What's going on these days?
Well, what we're seeing is we are seeing a busier January than we did, 12 months ago, right? Which is great because I think last year it was a very slow start to the housing market. It was a good slow, probably 3 months. Still coming off of, higher interest rates. Bank prime wasn't moving at that point there. And, I think people were just waiting for that first decrease, right? Which we didn't get till the middle of last year in 2024. So I think this year the optimism is there in that sense. We've had 1.75% decrease in bank prime. So we're at 5.45% on bank prime. And with discounting on that, you're mid 4.5%, right? Depending on what type of, mortgage you're doing, if you're doing a purchase or if you're up for renewal. So especially people that are looking to purchase, we're finding a lot of people that were pre-approved even than 6 months ago are coming back to relook at how much they qualify for because rates are coming down, but also mortgage rules have changed. We've seen a change the middle of December where we can now increase that amortization to 30 years from 25 if you are putting down less than 20%. And if you're putting more than 20%, you've always had the 30-year option. So that makes a big difference on payment. It can change people's payments. I've seen it like from $500 to, $700 a month, right? With that 30-year amortization. And I always tell people it's about managing that expectation of qualification from just to get you into the home. Then we can work on financial solutions to help bring down that amortization so you don't feel it so daunting like, oh my goodness, I got to pay this house for 30 years and I'm paying it down. No, there's financial strategies that we can work on and payment frequency solutions from going from biweekly to biweekly accelerated to help bring down your amortization, by 4 years. But it's gradual. And I think that people have to understand that like real estate's a long game, right? Values go up slowly. They should be. It's not what we saw in 2021, in 2020. That's not a normal market. A normal market is 4 or 5% annually. And so we should expect that we can look at ways to adjust your mortgage and bring down your amortization as, you get raises or potentially job promotions or a change of career. And your financial position becomes better with years that we can help maneuver that, right? So it's just helping you get into the home today. So people are more optimistic. We're seeing more people come back to us to get reapproved or actually enter into the housing market based on new rule changes. What can they do with themselves and their families to be able to get into that home? So that detached home price range and that property type is very popular this year, and I expect that the detached home market will be quite robust, not only just in our area, but I think across Canada.
There's been a lot of conversation too with people who are, maybe getting close to retirement, or they're going into their 50s or 60s, and they want to help out their children. And so instead of waiting until they pass and then there's an inheritance, there's that conversation around, can we take some of that money right now and gift that to our adult children to make it a little bit easier? Are you finding people coming to you and that's one of the ways that maybe mom and dad are helping things out these days?
Yeah, there's lots of conversations. We just had a seminar this past week on renewals, but I actually had some clients there from the community that came that were either one looking to buy their parents' home,
Right.
or moving their parents into a retirement home, and what does that look like in terms of that early inheritance for them to be able to buy. So we're seeing a lot more of that conversation, and there are statistics out there that are showing that the aging demographic is it's quite large in Canada right now, of that age group where they are in retirement, they are looking to do that early inheritance and be proactive on their actual equity and investment, so that they have that done, right? Before end of life, where traditionally we didn't see that until after end of life, right? Like it was done in your will, where people were actually doing it beforehand. So we're having a lot more conversations on, what does that look like to be able to do that. Reverse mortgages are quite popular in Canada as well. So people that are in retirement, that are on set incomes, you can look at reverse mortgages where you're not making that monthly payment, and people have equity. Like, let's face it, out of all the G7 countries, Canada is the most robust on value and equity wealth, right, over the last 5 years. So we're seeing people, if they haven't tapped into their equity the last 5 years, they could have up to 65-70% equity growth. And how do you tap into that if you're looking to retire? And remember, retirement is starting for some people a lot earlier than where it was.
Right.
And this type of product will allow that.
And luckily and thankfully, retirement's lasting a lot longer than it used to.
Exactly.
So you want to be in that frame of mind when you're taking a look at it. Bruno, I want to come back to you for a second, and we've taken a little bit of a look at what's going on south of the border. When you take a look at, if you throw into that a possible provincial election that's coming up, and then we know that there's a federal election going to be coming up as well too. Are there cautions that you would take when you're talking to people about mortgages, or when you're talking to anybody? Is it still that idea of kind of sit back and wait and let things settle out before making any big decisions?
I think that, again, if you're looking to buy your own home to live in, owner-occupied, depending upon your situation, I think it's a good time to buy now.
Yeah.
I mean, in Canada, we have stable governments.
Right.
So federally is what I look at more. And if you look at the federal government, I mean, this federal government has been around for 9 years. And, a new government, I'm not going to get political, but, I wouldn't wait for the outcome of the election if you were looking to buy, because here's the thing, like I said earlier, the number one worry in terms of interest rates is inflation.
Right.
And in Canada, our inflation rate is 1.8%.
Right.
And our inflation rate has been coming down quite a bit. The big issue we have is the influence from south of the border. I keep bringing them up, but
Right.
if inflation in the United States rears its ugly head,
Right.
that will impact 10-year Treasury yields, which will impact our 5-year Government of Canada bond yields, which might put upward pressure on fixed rates. And right now, the fixed rates aren't bad. Again, talk to your mortgage broker. If you're a high-ratio first-time home buyer and you can take a 30-year AM now, you can get some pretty reasonable payments on those. And the big challenge we have is south of the border. If a lot of what the new administration wants to enact, tariffs are inflationary, deporting millions of lower wage workers is inflationary, removing the Fed's independence, deficit spending. If they remove tax on tips and overtime and Social Security, you're flooding the market with more money, chasing goods that have tariffs on them. That's almost a double whammy for inflation.
Right.
So I think the big concern right now is the United States and what sort of inflation, upward pressure on inflation they have.
Okay.
So if we look at the rates now, and if you look at your own situation, you want to buy a house, the rates are pretty reasonable right now. Even on a fixed rate side, you can get a 3-year fixed, a 5-year fixed. The rates are pretty good for first-time home buyers and high ratio, but also on renewals and refis and everything else. I mean, your renewal's coming up. You can't wait. If your renewal's coming up in June, it's coming up in
That's
June.
right,
It doesn't
that's right.
matter who the prime minister is or who the premier is. So, I mean, when it comes to elections, we have lots of them, and I would just look at your current situation now and talk to your mortgage broker.
All right. You've got a question for Tracy. What's your question?
Hi, Tracy. I heard you talking about a reverse mortgage. Could you explain in simple terms so I can understand exactly what that is?
Yes, thanks so much, Mark. Absolutely. So, a reverse mortgage is a type of loan that's available for homeowners, and usually we're finding it's around 62 years old and then up. That we're finding a lot of people taking advantage of this type of loan. And what you're able to do with it is convert the equity that you have in your home into cash. So, unlike a traditional mortgage where you are, as a homeowner, take out a mortgage and you're paying a monthly payment to the lender, a reverse mortgage means that the lender makes the payment on behalf of the homeowner. So, you're pulling out, let's just say your home is free and clear, you have no mortgage on that property. We can then be able to, for example, do the loan for $300,000, but you're not making any mortgage payments to the lender. They're adding on the mortgage payment to your mortgage, so it in essence it increases, not decreases, with the payments. And the reason why that happens is that with a lot of people that are retiring, they're on very fixed incomes, so they don't have the cash flow for everyday expenses, and it could be medical bills or groceries and additional expenses. So we still want that quality of life, and this type of product is able to do that for people that are retired, still have the quality of life, be able to keep that cash flow available, and you're able to have that lump sum that you can do what you wish with it. You can either use it as everyday and monthly budget, which we do with a lot of people that are retiring. We help them manage their monthly budgets with the equity that's pulled out. We pay off outstanding debts so they're not cash strapped with credit card debts or unsecured loans at high interest rate. They also will pull out money to be able to do an early inheritance for their children that maybe be buying a home. So this product is able to pull equity out. You're still living in your property. You don't have the restriction of being able to have to pay these monthly payments, and you're able to still have a very good quality and financial wellness in your home.
No tax.
Okay, so do you have to be mortgage free? Number one.
No, you don't actually. You can have a mortgage on your property. There is a calculation that is based on your age and also the value of your property versus what is outstanding debt on there. So we can pay out existing mortgage debt that you have on there and then just put on a whole new first reverse mortgage. And one thing I do want to mention too is the money you do pull out is tax free.
Okay, but you do have to pay that money back, obviously.
Absolutely. So the whole premise on a reverse mortgage is that it's there to help you with transitioning into retirement and then that end of life. So at that point, if when the homeowner, when they pass away, that balance of the mortgage is paid off to the bank and lender that has given the reverse mortgage, and then the equity at that point is based on with the will that's already in place with the deceased homeowner in terms of who's able to get who has access to that will and who's been on the estate to be able to take advantage of that equity.
Okay, is there an interest rate on that?
Absolutely, yeah. So the interest rate on these loans are higher than traditional mortgages, but it's depending on the market, right? So right now we're seeing reverse mortgages in the range between 6.5% to 8.5%. It depends because there are different types of reverse mortgages. There's ones where you can treat it as a line of credit. So it's not given a cash amount lump sum. It's divided up over every month, where they're giving you the money every month. So that's done more as like a line of credit type of option. So there's different types of reverse mortgages. It's about sitting down with a mortgage professional, working out the best strategy based on your scenario, what you currently have, if you do have a mortgage on your property, what type of equity you have, what your age. It is based on age as well. So there is a calculation on that. That will help in terms of what that loan to value looks like. But it is a very, very popular product in Canada.
Okay, what did you say the interest rate was again?
They range, right? So between that 6.5% to 8.5%, depending on the term and the type of reverse mortgage that you get. And that's in today's market. So it does adjust, right?
That's actually more than a mortgage.
It is. Yep. It is higher. Yeah. You got to remember it's a unique product, right? So it's not something that, is now it's becoming more popular, but it's also, we're in a higher rate environment right now in Canada as well, even on traditional mortgages. Yes, it's come down, and it does come down. Like that rate does come down depending on where current interest rates are. So it is just depending on what's going on in the market at that point.
Okay, thanks, Tracy.
You're welcome.
Thanks so much for the call, Mark. We appreciate it. And anyone else, feel free to give us a call. We've still got time for some more questions as well, too. This past week, it has been, on the balmy minus 30, minus 25 range. But we've talked about the fact that it's almost, or it could be, we're tapping into the spring home buying season. Tracy, any tips or strategies for prospective home buyers that are going to be heading into the market these days?
Well, I can't stress enough about being financially prepared, right, for your mortgage, understanding where you're at with your pre-approval, because it can change from month to month. Again, we've had new rule changes, which is on the positive side for first-time home buyers, extending amortization. Interest rates have come down as well. So your pre-approval, we can look at it in today's structure, but in 30 days it could change depending on where interest rates are. Mm-hmm. And with this federal government, we've had a lot of policy changes in a very short period of time at the end of 2024. And who's to say we're not going to see more going forward, right? So being on top of it as a mortgage company for myself and being able to help our clients navigate and be on the pulse with their pre-approval is really important, because it could make or break a individual family situation on being able to buy that property. Because we are seeing right now, it's the beginning of spring market, and speaking to a lot of real estate agents, and I'm seeing it firsthand with clients, there are the start of bidding wars, depending on type of property, location, where that cost is on that home. Remember, we still have a supply shortage, right? And rates have come down. So there's a lot of opportunity and a lot of pent-up demand of homeowners, or I should say people that are looking to be a homeowner, getting into the market that have been sitting on the sideline. So I anticipate a busier spring market. I'm anticipating more of this, multiple offer situation because of that. And even last year in that transition market, we still saw values go up overall in Canada, and we still saw it especially in our region because we don't have the supply. And people do navigate during these times. They are working out solutions as a family or as a couple or individuals to be able to work through these financial obstacles to be able to still own a home in Canada.
And I would think, you have to go through that whole process of pre-approval. This is, you've got to be logical, and you've got to, this is what you are going to be able to afford. You don't necessarily want to stretch people beyond their means, because there's got to be a little bit of play in that as well too. And maybe you wanted to weigh in on that as well, Bruno.
So I'm a numbers guy, and when I look at the numbers, and I recently did a presentation in Ottawa, and what I did, and it's very similar in Kitchener in terms of the real estate market, and I took a scenario where in February of 2022 in Ottawa, your average home price was about $837,000, interest rates were about $299. Yep. On a 25-year AM, first-time home buyer, your payment would have been around $3,800 a month, $3,829. I did a scenario number 2, which is today. The average home price in Ottawa has dropped. December 2024, it's about $663. Okay. Given a 30-year RAM, given the lower price, even given an interest rate of 4.54, now that rate can vary and change, and it depends upon the day and what's going on with interest rates, but The rates are actually a little bit lower right now than that.
Yep.
But given that rate, just as an educational tool, the payment is now $32.85. And in February of 2022, there was 1,095 sales in Ottawa. In December, there was 613, yet the payments are $544 less a month. The price you paid for the home is less than it would have been in 2022 because that was kind of the peak of the market before the Bank of Canada started increasing rates. So again, talk to your mortgage professional, talk to your realtor. In February, remember, we had crazy market in 2022. In 2021, 2022, we had multiple offers. It was difficult to buy a house. Now, it might be a little, you still might get multiple offers, but I sense that it isn't as bad as it was back then, yet your payments, given the calculations and given the rule changes for first-time home buyers to go to a 30-year RAM and buy your first home, your payment might end up actually be less than it was. And this is Ottawa, my example, but if I used a Kitchener example, and definitely your mortgage professional can show you what the values were in February 2022, what the rates were, what your payments would have been, you might be in a very good situation this spring in terms of what your payment could be to be able to buy your first home.
And it's this too.
There's a lot of people coming out for renewal in Canada this year. It's 1.2 million in 2025 and then another million in 2026. In fact, the next 3 years is probably the biggest amount of Canadians that are coming out for renewal in Canada. And, when, especially if you look at it this year, 85% of these Canadians that are coming up are coming off of interest rates when they were at their lowest point, right? That 1.5% 5-year fixed rate, to 2. So it's a big payment shock. I've seen it from like $500 to $1,000 depending on mortgage amount. So this is why we're hyper focused this year with Valko Financial on creating seminars and mastery classes to really help people navigate their mortgage renewal, understand the nuances and what to prepare for to be successful for the renewal. Because what we're seeing is a lot of people are payment shocked by what's happening with where interest rates are today, where they're coming from, and they're not receiving the renewal statement till very close to their actual renewal date. And so they are not making that strategy ahead of time to be able to look at options out there. And Statistics Canada said that 74% of Canadians are just renewing their renewal. They're also not being offered all the terms that you can get on a mortgage at the time you come up for renewal. So people aren't understanding what their options are and not making the best financial strategy for their next renewal. So we've come up with a series of seminars. We just had a very successful one this past week. And we've focused on the topic, we're calling it myidealrenewal.ca. And it's really a framework to help people align with going back to this ideal framework of how to be able to look at their financing, their income, their debt, their equity in their home. What is their lifestyle that they want to still maintain or be able to manage over the next 5 years to be able to position them with the type of mortgage product and term that they need to be in that financial wellness for this next renewal. And this is why these recommendations of, when I hear this all the time, take variable, take fixed, short-term, long-term, it really is dependent on the client situation. No one's bank account is the same as the next person's. So we have to make sure that we're managing everybody specifically to where they are at now, but where they're going, right? And in the environment we're in today, so that people do have a good understanding foundationally of where we're at, because we know economy is going to change in 5 years, we'll be in a totally different situation. So these seminars we're going to continuously have, and we're going to do online ones and we're going to have in-person ones. You can check out our website at valkofinancial.ca. We also have our landing page at myidealrenewal.ca as well. That will have that information. But it was a great success, great feedback, a lot of information. The overall conversation I had is that, people are really concerned about their mortgage coming up for renewal and don't know what to do.
Well, and I think you're meeting meeting people where they're at as well too, and these are the concerns that people have. We've got another phone call coming in. Afif has got a mortgage question for us here, and thanks Afif for giving us some of your time. What's your question today? Right. Right. So right now, I'm just going to make sure we understand. So line of credit's at about $350,000 and about $25,000 left on the mortgage. Is that right? Okay. Tracy, so I'm sure other people are in the same situation sometimes. What's the best advice for them?
Yeah, and everyone's situation is unique to where they're at right now, right? So again, you've got, I'm assuming that's your balance on your line of credit. Is that correct? Okay. So, and we know bank prime is still high, right? At 5.45%. And most lines of credits out there with the banks, you're not offered the same type of discounting that if you were, let's say, in a variable rate mortgage. So people are paying higher interest. Their monthly payment is very minimum and it's just going to interest and they're not seeing that payment go down. And it's discouraging. So I can really understand and empathize with where you're at right now. I think taking a look at where you're at financially and the equity in your home, if there's a way, which we've done for a lot of people, is work on that solution of combining into an actual variable rate mortgage with a discount, so you'll get a lower interest rate as we kind of wait out the time for, we're still expecting bank prime to come down this year. The expectation is around 50 basis points. We'll see how this plays out with what's going on in the U.S. And then fixed rates are slowly coming down. So people can take advantage of a fixed rate down the road as rates come down. So we should take a look at what you can manage with your monthly budget, and then we can work on financial solutions of potentially consolidating this and extending amortizations to help ease and manage your cash flow and your monthly payment on this. But it's not an answer, just a one and done on the phone. It's let's sit down, let's look at where you're at on your financing so we can give you a really good, clear indication of where to go. Absolutely. Absolutely. Yeah. Well, I think the thing is that from a bank's perspective, just on a phone call conversation, it's tough even for me. Like, we have to see what you can qualify for. We have to see the equity in your home. Consolidation is definitely a reality there for this, but we do have to see, what equity you have, what we qualify. Now, you have to remember on the broker space, the great news for us is we have a lot of options and choices other than the banks and financial institutions. So if we do have to go with extended ratios, depending on what your income's showing, we have a lot more solutions out there for you. So you just need to give us a call and we can really break down that and give you some education and clarity. You're welcome.
Thanks for the call, Afif. We appreciate you giving us a call. And as we said, there may be more people out there that are in the same sort of situation. Always a good idea to give Tracy a call and get the conversation started. So coming up, lots of things on the agenda for 2025. Tracy, what's happening? We've talked about a little bit about the workshops that you've got going on. Other big items. What are the other things that are going to be happening in the next little while?
Yeah, we've got a busy 2 months coming up, I got to tell you.
Bruno, do you know how busy this is? You're along for the ride? That's good. All right.
So on top of the renewal and wealth mastery seminars that we have, we've got 2 coming up February 26th, one on March the 19th, and then 2 online ones on February 12th and March the 12th as well. We also have a family day skate. I'm happy to bring that back into the community. And we're going to have that on Family Day, which is February the 17th. And that is from 12:30 to 2:30 at Sports World. And we've got all the information on our social media platforms as well as on our website. And then our big initiative, which is I'm very proud out of, which is our second mental health fundraiser with Grand River Hospital, Care Never Stops Foundation. That's on March the 6th at the beautiful venue, Tapestry Hall. You can check out mentalhealthdinner.ca. Go to the Grand River Hospital website as well to be able to purchase tickets if you want to sponsor. All the information's on there. We're looking to fill that room, 350 seats, raise about $250,000 that evening that goes directly towards the hospital and mental health initiatives that they desperately need for the community. So I'm excited. I'm part of the foundation and chair of that drive, and very happy to see how the community and the businesses are coming together to make it a huge success for March the 6th.
Well, and